All right. Thank you everyone for joining us today. It looks like people are starting to sign on, so we'll get started. My name is Cece Mortar. I'm the Director of Business Development for the Steamboat Springs Chamber. I want to start by giving a quick shout out to our Business Education Series sponsors, Mountain Valley Bank, UC Health, Northwest Data Services, the Colorado Housing and Finance Authority, and Routt County. A couple of house cleaning items. Please switch your chat to everyone so that everyone can see your chat. We ask that you either put questions in the Q&A function or the chat, but you can submit them anonymously through the Q&A function. I will be sending out the recording and the slides this afternoon. And I'm honored to introduce our speaker today, Matt Stonehill. Matt has 15 years of experience tackling everything his clients throw at him. He specializes in service-based S corps and partnership tax, trust and estate tax, and tax strategies. And he's the perfect person to answer all of your questions today. We have a lot to cover, so Matt, I'll let you take it away.
Yeah, thanks for that introduction. So, a little bit about me. I am a CPA and a certified financial planner. I work with hundreds of small businesses and big businesses, individuals. So, I compiled a slide deck to kind of go over questions that I see out in the real world that I think some of you might have, as well as new tax changes and just things to think about. So I'll start with the slides. There's a lot of information, but if you have a question, just put it in the Q&A and I'll answer it because I want to make sure I'm kind of speaking to what you all are seeing. So on that note, I will start my slides and we'll kind of go from there. Screen two. Okay, there we go. So I'm going to start with just how can I reduce my tax? And I've been using AI to kind of generate some of these images, which kind of leads me to make a couple comments. So this AI is getting pretty good. I think a year ago, this guy would have maybe one big tooth and like a couple extra fingers. So that's pretty good. He's excited about a reduced tax liability, which I hope you know you guys will feel the same. So just a refresher, what is deductible for your business? Something deductible is it must be ordinary and necessary to your line of work, and so that can be flexible. It depends what you do. Something ordinary and necessary for a consultant would probably be different than a plumber, for example. I get this question a lot. Are nannies? Can I pay my nanny through my company payroll? The answer is no, because a nanny and having a child and child care is not ordinary and necessary to any line of work. Clothes are also not deductible. I get that a lot, especially from realtors or maybe content creators. They want to look nice and get their hair done. So clothes are not deductible unless it's very specific, like a hazmat suit, for example. I get questions on meals a lot. So meals with a business purpose, you're taking a client out. It's a late working lunch or dinner. Those are deductible. But if you're eating out every day or multiple times a week, it's going to be seen as personal. So just keep an eye out on that. I have what's called an accountable plan here / home office deductions. So you can deduct portions of your home, rent, utilities, internet, depreciation on the home. That is deductible for a business owner, but the way it's deducted changes based on if you're an S Corp or not an S Corp. But those are certainly deductible. The key with that is you need a separate dedicated home office. So you can't work at your kitchen table and try to write off your home. Business use of vehicles, I want to mention this because um, just because a car is not owned by the business doesn't mean you can't take expenses for business use of the car. The easiest way to do that is just taking the standard mileage rate. It's 70 cents a mile right now, which I think is pretty good. But if you're using it predominantly for business, you should think about putting it in the actual business itself. I want to talk about depreciation because there's been some big changes on that. So depreciation, it's a non-cash expense charged against assets and real estate used in a business. So any asset purchase under $2,500, you can just write it off in the first year. So a photographer buys a camera for $1,500. Nothing special needs to happen. You can just write it off. If you buy something over $2,500, then you do have to put it on the balance sheet and depreciate it. But as I'll go over on the next slide, there's accelerated depreciation that's available. So you can end up, expensing it all anyway. So accelerated depreciation, it's really just normal depreciation, but faster. So you'll hear 100% bonus depreciation referenced a lot. That's available for any asset in the business other than kind of your real estate. If you own your building, you can expense 100% of an asset purchase in the first year. There's also what's called Section 179. You can expense up to 2.5 million in a year. The difference between the two on like when you would take one versus the other is that bonus can create a taxable loss, but 179 cannot. So if your margins are kind of thin, maybe you're in the startup phase, but you need to buy a business truck, for example, I would take bonus because it will be able to create a loss. Qualified business income, QBI, also referred to as a pass-through income deduction. This has been around since 2017, but it was set to expire. And so now it's been made permanent. And there's this new $400 minimum deduction. So as long as you have a certain amount of qualified business income, you'll at least get a minimum deduction. But this applies to income from pass-through entities. So think sole proprietorships, partnerships, S corporations. There are special rules if you're in a specified industry, which is health, law, consulting, most service-based industries. You won't get a deduction if your income is over a certain amount that I have listed there. I talk about this a little more throughout the presentation on how different items, whether you're an S Corp or a partnership, kind of impact this deduction. But it is a 20% deduction of your qualified business income, which can be a very significant tax savings. Retirement planning is kind of the lowest hanging fruit on clients who want to save money on taxes. I always go, well, okay, you want to save on taxes. What are you doing for retirement? If the answer is I don't have a retirement plan, then that's the first thing we talk about. So there's a lot of different types of plans, and it can be a little overwhelming. So I caution you to kind of think about balancing you as a business owner. What is your objective with retirement? Do you want to put a little away? Do you want to sock away as much money as possible? Do you want a cheap plan or more robust plan? There's also different requirements for what you need to contribute for employees. So you want to balance, okay, I want to maximize my own retirement, but if I do that for all my employees, that's too expensive for me. So you'll see simple IRAs, simple 401ks. Those are literally the most simple. They have lower contribution amounts, but they're easier to administer, they're cheaper. Then there's a normal 401k. It will allow you to put more away, but there's more administration, it costs more. And so if you're thinking about setting up a retirement plan, I would advise, yes, that's a great idea, but just know there's a lot of different options and you really need to weigh what you're trying to accomplish. If you're an S corporation versus just a sole proprietor, single member LLC, the way your retirement contributions are calculated is different. So as an S corp owner, your retirement is based on your W-2 wages, versus for non-S corp, it's based on your entire business profit. So most cases, all else being the same, you would be able to contribute more if you were self-employed than if you're an S corp owner. So there's some planning opportunities there on, do you increase your wage so that you can contribute more? But just know that there are kind of different calculations. No tax on tips. This is new for 2025. It came from the new One Big Beautiful Bill Act, OBA, where employees and self-employed individuals can deduct up to $25,000 of qualified tips. It's an individual deduction, and so employers withhold tax and Social Security, Medicare, just like normal, and then the deduction is taken on the individual return. It does phase out, so not everybody will get benefit for this. If your adjusted gross income is 150K if you're single, or 300K if you're filing joint, then you're going to get a lower deduction. No tax on overtime is also new. It applies more to employees and less to business owners, but it's important to kind of bring up. So you get a deduction up to 25,000 if you file joint for the half portion of 1.5 time pay when you get overtime. And so just like no tax on tips, employers withhold income tax and FICA payroll taxes just like normal on the overtime, and then the deduction is taken on the individual return. So this is brand new, never existed before 2025. Nothing for employers to worry about this year until reporting requirements kind of change next year. A pass-through entity tax election is if we're in tax 101, this is tax like 201. It's a mechanism to avoid limitations on what you can deduct for state taxes. So before 2025, you could only deduct $10,000 of state taxes on your individual return. What a PTE election does, it allows the business itself to pay your income tax to give you a deduction for that tax. So instead of taking on your individual return, you actually get a benefit for the state tax, reducing your business income. It's a little confusing, and if you're thinking about, hey, this might apply to me, then I definitely caution you to talk to a CPA about how it works. But I think it's a really good mechanism. So say I'm taking the standard deduction anyway, so I'm getting $30,000 of a standard deduction. Well, I wouldn't get benefit for additional state taxes on my individual return. That's just not how it works. But if I made this election, then my business would get an expense for my state taxes. So you're kind of double dipping there. And I think it's awesome. In Colorado specifically, the election is pretty straightforward if you do it the right way. And so it's something to maybe bring to your tax advisor as something to discuss further. I'm not going to go into crazy detail on how these credits work, but I do want you as a small business owner to be aware of certain tax credits that I think will apply to you. And so if you provide paid family and medical leave to your employees, you're likely eligible for a credit. If you provide childcare, if you set up a retirement plan, then there's a really good tax credit that actually will cover all of the setup costs for many small plans. I think it's up to $5,000 that you get a credit for when you set up a specific type of retirement plan. So if you don't have a plan for your employees right now, and you're kind of daunted by the setup costs and the administrative fees, well, there is a tax credit that will give you some help with that. Research and development credit can be a whole other presentation, but if you're developing or improving products, processes, softwares, really just using a scientific method to make something better, then it likely qualifies for this credit. A lot of people think it applies to Google and Microsoft, and you have to be some big tech company to apply. But I've seen a whole bunch of different types of businesses, small and large, get credit for this. A FICA tip credit, what does that mean? So an employer can get a credit for Social Security and Medicare wages paid on certain tips to their employees. It used to just be food and beverage uh, businesses, but now it applies to beauty services. So think barbers, nails. I want to say masseuses qualify as well. Um, so I hope people are taking advantage of that. I know we have a lot of food and beverage and beauty services in town. So that's definitely a good credit. And then if you offer a healthcare plan to your employees, then there's also a credit for that. So again, I'm not going to go into details about how each credit is calculated, but I think this is a good list of items that might save you taxes. So I don't see any Q&A yet. Just want to say, I'm happy to answer any questions as I kind of went through tax savings techniques. But I can keep going if there's nothing. So things you should know. This guy is intensely reviewing what looks like a blank piece of paper on the other side. So these are items that, again, working with small businesses that I see come up a lot. And so I want to just give you some information about things that you'll encounter in the world. So worker classification. What this means is if you hire somebody, they can be either an employee or a contractor. An employee gets a W-2 and a contractor gets a 1099. The way that you determine if somebody is an employee or a contractor is based on the facts and circumstances of their relationship to you. And what that means is if you can control how, when, where somebody does their work and you review their work, then they're likely going to be seen as an employee. Versus if you can't control where, when, how somebody does their work and you're not really reviewing it, then they're going to be seen more as a contractor. An example is if you hire somebody to build a website for you, yeah, you're telling them, yeah, I want a website and I want it to do these things and show a certain way. But you're not telling the website designer exactly where, when, and how to perform the work. And you're not reviewing their work from a technical standpoint. So they would be a contractor to you versus hiring a full-time assistant who comes to your office every day. They're going to be seen as an employee. The question I get on this a lot is, I'm hiring somebody, what's the most tax efficient way? Should they be an employee or contractor? The answer is it's more tax efficient for an employer to have a contractor because you don't have to pay payroll tax. But the determination cannot be based on that. If the IRS comes in and questions your classifications, you can't say, I was trying to save payroll tax. That is not going to look good. Another question that I get a lot is passive versus active income. So if you're materially participating in a trade or business, and there's ways to test that, but basically if you work over 500 hours in an activity or you provide the most amount of services, or there's 7 tests, but basically if you're active versus not active in a business. So not being active is called passive. If you're passive in a business and you have a loss, that loss cannot offset active income. Passive losses can only offset other passive income. So a question that I get a lot is, hey, I have my business and it makes all this income. So I'm thinking of buying real estate and it's going to run at a loss. Can I, get benefit for that loss? The answer is no, because your business would be seen as active and rental real estate would be seen as passive, and the two can't combine. So I see that trip up a lot of people thinking that they're going to have some massive tax savings only for a loss to be disallowed. Rental real estate, I have a comment here. It's default passive unless you're a real estate professional, which is specifically defined. Airbnbs are kind of this gray area of the tax code now. I would say if you're renting your Airbnb for, on average, less than 7 days and you're significantly involved in turning it over and cleaning, there could be an argument that it's not passive, but I'm not going to get into that world right now. This one's important. It says, the internet says I should be an S corporation. Is that true? So I get this question a lot is, my neighbor is an S corporation and he said I should be an S corporation. Or I saw it online that it will save me all this tax. So I want to talk about what an S corporation is, what it does to save tax, and kind of things to think about. So if you're a single member LLC, a sole proprietor, or a partnership, all of your business income is subject to self-employment tax. It's 15.3%, in addition to your ordinary income. An S corporation allows you to pay yourself a wage. So you pay self-employment tax on just the wage. And business profit in excess of that wage is not subject to self-employment tax. So there's very real savings with the 15.3% not being applied to all of your business income, but it comes with additional headaches. So if you're a single member LLC, there's no separate business tax return. If you elect to be an S corporation, then there is an annual business tax return. So now you're paying somebody to prepare a tax return that you weren't before. And you also have to be on payroll. So if you've never run payroll before, then all of a sudden you have to register for payroll, pay somebody or, a gusto to run payroll for you, deal with all the IRS letters and notices about withholding rates. There's just a lot of additional headaches and compliance costs that come with an S corp. So there is a bit of a break even. I would say if your net business profit is at least $50,000, so revenue minus expenses, then it's worth a conversation on if an S corp will save you money. If you need somebody to prepare the business tax return and handle all the compliance for payroll and anything else, then the break even is closer to 80,000. So I get this question a lot, should I be an S corp and their profits around 60,000? Yeah, I would never recommend to somebody that they elect to be an S corp and then use all of their tax savings to pay for the compliance costs, because then what's the point? So around 80K, hey, you can pay somebody to do all the headaches and you're walking away with several $1,000s of tax savings. There is a bit of a break even. So the QBI deduction, the 20% of your business profit, is an awesome deduction. But when you elect S Corp, your share of like your wage from the business will reduce that amount. So it's another factor that kind of goes into, am I going to break even on being an S Corp or am I actually going to walk away with tax savings? I see the QBI reduction get missed by a lot of CPAs. They only look at savings with self-employment tax, and they're missing the fact that your 20% deduction is going to go down by your wage. So something to keep in mind if you're having that conversation with a tax advisor. I'm sure by this point, if you own a business, you've issued 1099s or you've received 1099s. So there's been some changes. 1099K is what you would get from Venmo or PayPal, anybody that processes payments for you. They used to have to be filed if your payments were over $600. So everybody started getting this 1099K and nobody knew what it was. Well, now starting in 2025, they only need to be reported if your gross payments are over $20,000 and you have at least 200 separate transactions. So that might still be applicable to you, but for the most part, a lot of small businesses are going to stop receiving 1099Ks. There's 1099 non-employee compensation and miscellaneous. If you had a contractor, you would pay them with a 1099 NEC. The reporting threshold increased. It used to be $600. So if you paid any individual partnership more than $600, you'd have to issue them a 1099. It's now $2,000, and that $2,000 will increase for inflation moving forward. That only applies for 2026 and beyond. And so for 2025, if you paid somebody over $600, you still need to issue them a 1099. So there's likely a reduction in both the 1099s filed by you and received by you, simply because the thresholds of it have increased. So there's a question, does that impact how we send 1099s? The actual filing and sending of 1099s has not changed. It's just there's a higher threshold for who you need to send a 1099 to. So before, if you had, 10 contractors and you pay them each $1,000, you would need to file 10 1099s. But now they'd be under the $2,000 and you wouldn't have to issue any of them a 1099 in that example. Sales tax, there's been some big changes in sales tax. It's not new, it's a couple years old, but you might have heard reference to the Wayfair ruling. So I have this word nexus, sales tax nexus. What nexus means, it is your financial connection to a state. And if your financial connection to a state crosses a certain threshold, then you'll likely have reporting and filing requirements. So sales tax used to be very local. It's where you sold your goods. It's where you shipped your goods from. But then Amazon and online marketplaces became popular, and all of a sudden somebody in Steamboat Springs, Colorado can be shipping sales all over the country. So now each state has their own rule on, hey, yeah, you're not physically located in my state, but you're selling a lot to customers in my state. They might say that you have sales tax reporting requirements in another state, even if you've never stepped foot in that state. It sounds scary, but every state has their own rules, but a lot of them are pretty high. So I just looked at Nevada, for example. If you're shipping to customers in Nevada and your Nevada sales are over $250,000, then you'll have nexus in the state, which means you'll have to pay Nevada sales tax. But if you're under $250,000, then you don't. need to file sales tax. So a lot of states have thresholds anywhere from 100,000 to 500,000, and also number of transactions. So if you have over 200 transactions in the state, that might trigger Nexus. So the takeaway on this slide would be, if you're subject to sales tax and you're shipping a significant number of sales to a certain state, it would be worth looking at that state's sales tax rules to see if you're required to file. Another thing about sales tax is just keep an eye out on your filing frequency. Depending on your sales tax liability, you'll either have to file monthly, quarterly, annually, and it's just something to keep an eye out because it does change. So income tax filing requirements. What I mean by this is, if you're doing business in multiple states, do you have a filing requirement in the non-resident state? This trips up a lot of people that say, I'm based in Colorado. Yeah, I have clients all over, but why would I ever file a non-Colorado tax return? Well, in certain situations, you might be required to. So every state has a different rule on defining your connection to the state. A lot of them are just based on sales. And there's two ways to kind of source your revenue. One of them is based on where your customer is located, and one is based on where the work is performed. So you can work, Virginia, for example, sources revenue based on where the work is performed, and Colorado sources it on where customers are located. So in that example, if I had a Virginia business and I did all the work in Virginia, but it was all for Colorado customers, then my revenue would actually be sourced to both states, and you would end up paying tax on more than your total sales. And so you need to look at, are you selling significantly to another state? If you are, it's worth talking to a tax advisor or asking ChatGPT how they source income to that state, because you don't want to get caught with Nexus in a state over multiple years, but you're not filing tax returns. If they catch you, they're going to make you go back to the beginning of when you entered the state. You're going to pay taxes, you're going to pay penalties. It's not a fun exercise. The revenue sourcing rules that I described are mostly for service-based. If you're making a good and you're selling the good, there's different rules. It looks at, where does title change hands? If you have a warehouse located in another state, you would want to look at that state pretty closely on, will they source the sales coming out of the warehouse to that state? I put employee location because the easiest way that a state can figure out that you're doing business in their state is by having an employee and paying payroll taxes for them. And so if I'm in Colorado and I have an employee in California, well, I'll be withholding California income tax, paying California unemployment insurance. On a W-2, I would have registered for payroll with the state. There is a big old paper trail in California that shows I'm doing business in the state. So again, if you have an employee in a non-Colorado state, I would look at that closer to see the specific rules and kind of what is the risk of not filing versus filing. So there's a question, does this apply to service-based businesses? Yeah, there's different rules for service-based businesses versus if you're making something versus if you're a professional athlete, there's different rules. the takeaway is for service-based businesses, states source your sales based on the customer or where the work is performed. And then if you're selling goods, there's different rules on where the shipment happens and title transfers and so the takeaway without memorizing all the different rules is, hey, I have a significant number of customers in this other state. I should probably look closer at that. Or, hey, I have a warehouse in Wyoming. I didn't even think about filing an income tax return. Let me look at those rules a little closer. So continue with the things you should know section. Couple comments on payroll. So if you're an S corporation owner, you must pay yourself a reasonable wage. There is no percentage of, oh, I take 30% of my business income and that's my reasonable wage. It is a subjective and objective test that looks at your business, your industry, what would you hire an unrelated party to do the work that you're doing? How much would you pay them? And it is different for everyone. So I had a spine surgeon, S Corp owner. His reasonable wage was $750,000. It just depends. Had the spine surgeon tried to argue that his reasonable wage was $50,000, that would never hold up any sort of scrutiny, because you could easily look at other spine surgeons. Hey, they make this amount of money, and 50,000 is not reasonable. Going back to kind of our state nexus, so payroll will definitely impact potential filings. So if you have an employee in another state, you need to think about that state's workers' comp requirements. You need to think about registering with that state for payroll. If you register for payroll, they're likely going to ask you, hey, are you going to register for, are you going to file an income tax return? So that's one way that they can kind of catch you. And then again, having an employee in a state does factor into whether you have nexus in that state, and it can trigger income tax filing requirements. So whenever employees move around or you're thinking of hiring, it's definitely worth considering how it will impact your tax requirements. Another question that I get a lot is profit versus distributions. So if you're an owner of a pass-through entity, you're going to pay tax on your share of income whether or not you took the cash out. So when you have taxable income but you don't take cash out, it's called phantom income, which means you're paying tax on money that you never received. So you do want to try to limit the amount of phantom income. But the actual taking of cash out of the business is not a taxable event. You pay tax when the income is earned, not when you take the money out of the business. I've seen some people get tripped up saying, I'll leave money in the business because I don't want to pay tax on it this year. Well, that's just not how it works. I say cash distributions are usually not a taxable event. As long as you have enough equity in the company and you're not taking out too much, then you're not going to pay tax on it. So here are some IRS red flags that I think would be important to keep in mind. So the IRS, especially now, they don't really have a lot of resources to go after complex cases. So they rely on computer matching of a lot of things. And two things that they use computers to match all the time would be owner's compensation and 1099s. So owner's compensation on the tax return for an S corporation, you report your industry and you report the owner's compensation totally separate. There's a whole separate schedule for it. And they can very easily look up your NAICS code. They have a threshold of, hey, business owners in this industry make between this and this, and then they'll compare your reasonable compensation. If it's too low or it's too low a few years in a row, it's going to get flagged. It's kind of one of the lowest hanging fruits for the IRS. Same with 1099s. So 1099s exist solely to match income. So you're saying when you give somebody a 1099, hey, IRS, I gave this business, this person X amount of dollars for income. If you don't report that on your tax return, the IRS can pretty easily match that up. And they'll issue a notice saying, hey, your income is lower than what was reported to us. What's going on? So if you get a 1099, you'll want to report it. If you get a 1099 incorrectly, like somebody gave you the wrong amount or they shouldn't have given you a 1099 for whatever reason, I would still report it on your tax return and then maybe record a reduction for the same amount. Like you do want to put it on the tax return, even if you deduct it off so you're not paying tax on it, just so you don't get a matching notice. And you would only do that if the 1099 is truly incorrect. I'm not telling you to just write off your income. Paying minor children. I get this question a lot. And you're allowed to pay your child for work performed in the business. It has to be legitimate work. The pay has to be reasonable. And it has to be, applicable to that child's age. So saying a 3-year-old was building your marketing strategy would not fly because obviously a 3-year-old cannot do that. Paying a child $30,000 for 10 hours of work sweeping the floors would not be reasonable. So it is a good tax savings tool if a child is actually working in your business to pay them a reasonable wage because the business gets a deduction. And then if it's under the child's standard deduction, then they won't pay tax on it. And if they're under 18, they don't need to pay payroll tax on it. So if they're performing legitimate work, you can pay your minor child tax-free up to a certain amount. So it's a question I get a lot is I want to pay my 8-year-old to work on my marketing deck. Okay, well, what do you want to pay her? I'm looking around. I think $80 an hour would be reasonable. I don't know. I don't think paying an 8-year-old $80 an hour to do work is reasonable. Worker reclassification is important. If your industry doesn't normally have a lot of contractors, but you're paying all of your workers as contractors, it's going to get flagged eventually. And the IRS will come and ask questions on, what is your relationship to these workers? Do you control how, when, where they perform their work? They want to make sure that you're paying in the right amount of payroll tax. And so an industry where it would be common to have contractors would be sales. A lot of realtors are contract. They might work for a brokerage, but the brokerage isn't saying you need to be at your desk 8 hours a day, Monday through Friday, and we would need to review all your listings. No, they're kind of on their own to do their own thing, make the sales, work when they want to work. So that's more of a contractor relationship. Versus as an accounting firm, if I had 3 staff accountants who came to the office every day and I was providing feedback and reviewing their work and they were listed as contractors, that would not fly. just a point on record keeping. Question I get a lot is, do I need to keep my receipts? Your tax preparer doesn't need to see every receipt you've ever had. We don't audit your numbers within reason. So if you tell me your utilities expense was $1,200, I'm going to report $1,200. I don't need to verify that it's $1,200. But the IRS does require that you have the receipts for 7 years. So if they ever were to audit your tax return, they will ask you, okay, prove your utilities was $1,200. So you will need to have the receipts to back it up. So in the real world, what that means is I would just get in the habit of keeping all your receipts, keeping invoices paid, dumping it somewhere on your computer or an external hard drive, and just keeping it if you ever need it. If you told me that your utilities expense was $100,000, then I would be required to kind of ask you about that. That doesn't seem reasonable. Some unsolicited advice that nobody asked for. If you're doing your own bookkeeping, Xero is significantly better than QuickBooks Online, and it's cheaper. Xero is a little more intuitive. There's less bells and whistles. The QBO released an update recently, and their dashboard gives me a headache every time I look at it. There's too much going on. There's way too many options. They're constantly blasting you with additional services and, hey, have you done this? Have you done that? It's too much. It's overwhelming. Xero is a much better experience if you're looking at doing bookkeeping yourself. If you're subject to sales tax and you're having trouble keeping it all organized and compliant, there are sales tax specific softwares out there to help. Avalara and TaxJar are two of the main ones. They'll tell you what you need to withhold per location. They'll handle the sales tax withholding. They'll handle the sales tax return filing. So that could be helpful for you if you're subject to sales tax. Another piece of advice is that, if you're doing your own bookkeeping, it's better to stay on top of it than try to do it all at year end when your tax accountant asks you for your books. It's easier when you're reconciling monthly. If there's an issue, you can just go back a couple of days or a couple of weeks and say, oh, I remember that transaction, versus trying to go back 12, 11 months to figure out what was going on. So just keeping up with it just makes everything a lot better, make your life easier. And then, if you are doing things yourself, like books, and you're spending way more time on it, and it's taken away from doing the thing that is making you money, then it's probably time to seek professional help. CPAs like myself, all we do every day is think about taxes and accounting, and it's what we do. And at a certain point, it just makes sense to have somebody else do it. Seeing if I have other questions or something in the chat. I mean, I do like hearing myself talk, so this is good.
There's a couple questions in the Q&A.
Yeah, I see two, and I think I answered them.
Oh, perfect.
Yeah.
Well, there's a lot of information. I know I feel like it took so much in. I almost need to think about the questions. But I would say if you have anything else, continue. Otherwise, we can give people a couple minutes to put in questions now.
Yeah, I have just a couple more things. And then yeah, questions about what I talked about or didn't talk about would be awesome. But yeah, I have a couple more wrap up slides. Okay. Let's do this. Avoiding interest and penalties. So here's somebody actively running away from interest and penalties. Estimated taxes. Here I have two rules on ways to avoid penalties and interest for not paying in enough tax. You can either base it on the prior year or the current year. One little tax hack is if you haven't been paying taxes, well, they needed to be paid evenly each quarter. But if you're an S corporation owner and you're paying yourself a wage, well, withholding through a W-2 is treated as being paid evenly throughout the year. So, if you need to get caught up on estimated taxes, then you could think about running it through your payroll and then you won't be penalized. Extensions, they extend the time to file your return but not pay your tax. So just because you extend your return in April, if you think you're going to owe tax, you need to pay it or you'll be subject to penalties. Another tax hack, if you pay estimated taxes and you're extending your return, well, Q1 for the next year is due the same day as the returns. So if you pay them as an extension payment, it gives you a good cushion and some penalty protection. Too much because it's more technical, but it is a way to kind of buffer against penalties. And then here's a guy being buried by the tax code, or maybe he's part of it now. I don't know. So what's new this year? I talked about all this in earlier slides, but there's a lot new this year. The One Big Beautiful Bill Act expanded credits, made things permanent, expanded deductions. The no tax on tips or overtime, that's brand new. And then there's a lot of individual tax changes that I didn't even touch on in this presentation. So if you have questions outside of this, happy to talk about the impacts of this bill on you, your business, but there's a lot. And then I won't go through every date, but I did provide in the slides some key dates.